Hey, good evening, everyone. Marty Mazora here, Tuesday, the 25th of July, 2023, with your midweek stock market snapshot. Clients will email it to you, or it'll be attached to an email, or the link will be attached to an email tomorrow morning. This will serve as Wednesday morning's message. Got to tell you, I was tempted just to skip tonight. The technicals really have not changed notably at all. So I thought I'd actually finish with those tonight, start from the other end with what I would normally supplement the presentation with. And I will approach the technicals from a market top versus market bottom look, really what the market tends to look like at extremes. But I thought that, speaking of extremes, I start with the S&P 500 one-year chart that I just put together and put these red circles on, and talk about that in the context of what Citigroup's fear greed barometer currently scores at, which is 81, which is in the extreme greed territory by their estimation. And so they provide a one-year chart of their score. So I snipped that and went back and put a red dot right where we had these peaks in that high greed or extreme greed territory. And then I went to our own chart here and put those red dots. So this is exactly the date where the fear greed barometer peaked. And as you can see, this is exactly where the bear market rally at the time had peaked, and we went down and established the low so far for the current cycle. Then we ramped out of that, and then we peaked again right around 75 on the fear greed barometer, and you can see what the market did thereafter. Peaked, it looks like around 80 or so right in here, so you get it. So this is that everybody's kind of getting on one side of the boat, and that would be the bullish side of the boat. And when that boat begins to take on some water, everybody kind of rushes to the bear side and sells their equity. So not, massive since that February peak right in here, but every time we got into this extreme territory, we had a sell-off. So now we're at 81. The bear market high so far has been 83. And as you can see, the S&P continues to kind of barrel its way higher. So this would be a red flag, of course, from a sentiment standpoint. There's the AAII, American Association of Individual Investors. You've seen this before from me here. And what I've done here is I've shown you the gap. This is the bearish percentage. This is the bullish percentage. When I put this together, I was showing you that we were pushing a bullish level that we hadn't seen since right before the peak, the all-time peak in the stock market. And then what I did is I showed points where either bullish sentiment crossed over above bearish sentiment, or where the gap got really, really tight. And then I circled below those points when things reversed. And of the 2, 3, 4, 5, 6, 7, 8, 9 times where I could identify these tight positions, if you will, or this growing bullish sentiment, looks like 6 of those times the market rolled over to a degree that you'd notice. 3 of those times the market continued to go higher, right? So now we are clearly at an extreme. This is a gap that we have not seen in a very long time, right? The gap between the bulls and the bears. So this would be something to be cautious about. So the implication here, once again, is that everybody's bulled up, at least in terms of the retail investor. And therefore, you get a little bad news, you get a little bit of a scare, and if they run for the exits, it could be more than just your little blip down at some point. And again, I'm not predicting that at the moment. We are anticipating that before this cycle plays itself out, as we talked about. There's a lot of deep analysis that goes into that. But this is just kind of the shorter term, more surfacey data and indicators that we pay attention to, our overall macro view, that stocks are still precarious here, and some of the short-term dynamics are telling us that while it may not occur, in the next few weeks, let's say, when the market does roll over, assuming it does, before we're comfortable that we're in a new sustainable bull market, these are the kinds of things that signal that that's the top. Doesn't mean it has to be this time, but we do think when that final top is there, it's durable, it's lasting, that this is how a lot of these indicators are going to line up. One more from a sentiment standpoint. Literally, as I was putting together my charts, I got my email from Investor Intelligence on their latest advisor sentiment. So I'm going to snip their commentary on the bulls. Hope you can see that okay. So the bulls edged higher to 55.6 from 54.2. That is above the final June count of 54.9. The most bulls since November 2021, again, right before the peak, when they reached the danger level of 57.2. You get above 55%, and it's the initial caution level. So it's not as, I'm using air quotes, euphoric as perhaps the AAII chart here or Citigroup's Fear Greed Barometer, but we're in that territory where you begin to start thinking defensively. Now, for our own Fear Greed Barometer, we track the bull-bear spread, and at 36.2, a difference above 30 is the first sign of elevated risk, and the wider the positive spread, the higher the risk again. So, history really bears this out, that when you get sentiment too far to one side of the boat, there's a good chance that you're at an extreme in terms of market action. Now, remember last week and then again in this morning's written note, I highlighted 7 reasons why this market's done so well in 2023. I added one to it this morning if you didn't get a chance to see that. And one of them was that, the market's just not going to roll over when everybody's bearish. And that's how everybody came into 2023. Here you are, right, with just a big, big gap. It's nearly as big as the gap here between the bulls and the bears. You can see it here as well. So you had very bearish sentiment late last year. And you can see what the market's done as we've kind of worked that off, and now we're at very bullish sentiment. So this looks much more like a top than a bottom in the market. Okay, so as for the charts, we are continuing to move in this rising wedge pattern here on the S&P. We have still a bearish divergence here on the moving average convergence divergence momentum indicator. We do have it here, even though that looks flat. You have a higher high, but you don't have a higher higher in the RSI. Notice these bold circles here. As you can see, this is just the 4th time. We were there right before the all-time high in the market, right? Then when we came down and then established a marginal new high, we had a bearish divergence on our 2 momentum indicators that we use the most, right? Here, kind of the same look. Marginal new high, bearish divergence on both of these. So my point here is that this looks much more like a top than it does the bottom. And by the way, here's the other time when we were clearly overbought, was right when we got this August peak before we barreled down to the so far bear market low. So what a bottom looks like, right, is you're oversold, right? You're below 30 on the RSI. And then you have bullish divergences while you get that last leg lower. These are patterns we drew at the time, right? So we were telling you this looks, at least short term, very bullish, right? Those are the makings of bottoms, right? Nearly oversold, boom. Definitely oversold. Nice little rally right there. So folks, right now, as we sit here today, this is a look that looks very, very toppy. You've got the Fed meeting this week. We also have the ECB, the Bank of Japan. We have some inflation data coming out this week. I told a friend of mine earlier today, I think it's just about 50-50. I think the market's going to move a lot. It could end the week right where it started, but I think we're going to get quite a bit of movement over the next few days, and I'm sure everybody thinks that because it makes a lot of sense. Whether we continue to meander higher or we break down lower. Right now, I could make a case either way. The technicals are suggesting that the big risk is to the downside, that there's probably not a ton of upside to be had from these levels right here. And there's so much more equity risk premium and valuations and all these longer term things we can talk about. Right now, just on the short term technicals, looks toppy, or like I said the other day, looks heavy to me. And then for the NASDAQ, again, you've got these bearish divergences. Very overbought. You've just been bouncing in a very overbought level right here in the NASDAQ. And by the way, overboughtness can fix itself by going sideways, right? It's just that the risk is coming off of these levels with these patterns. The risk is not small to the downside. And when were we overbought so far in this bear market? Right here, right here. And that's not quite even overbought. Last time really we were just this substantially overbought was right at the all-time market high. Here we are. We could see a nice test. Get some more good news. Microsoft did not help this index in the after hours tonight with their earnings report, and just there was a concern or two in there. Google, however, blew the doors off, and it was trading a lot higher in the aftermarket. Texas Instruments was lower, though, some issues in the chip space and so forth. So a lot of mixed readings. We've gotten this nice run. I think it's been chased big time by underperforming institutional managers. And I'll just kind of close on that theme. People like Mike Wilson, who was one of the more celebrated bears with Morgan Stanley. I just keep seeing all these headlines that he's capitulated. He's apologized to clients. They were bearish coming in. He said they were wrong. Reading his actual commentary, they're still bearish. They believe the S&P is going to end lower than it is here by the end of the year, and they have a target, I think, of 3,900 for next year, if I recall. He did have a target of 3,000 for 2023, which is a lot lower on the S&P than we are right now. Our view is that this market is still very much in trouble, that the macro does not support valuations where they are right here, that it does not support the earnings projections. And by the way, clients and hopefully viewers as well know that it's all about, in our view, just simply looking at the risk-reward setup. Is this something we want to really aggressively engage in? And we're happy to engage aggressively in the market when the setup tells us to. Or is it something that we want to place some defense in, make money where we can, and be prepared either for the fall off or the fallout to occur and take full advantage of it, or wait for our forecast to clear and then be more comfortable taking on more risk in portfolios. We're just not comfortable going there of yet. And I got to be honest with you, the more the bears either capitulate and become bulls or delay and start scaling in, quite frankly, as I've shown you in these sentiment indicators, the more concerned we get sooner than later. So it's going to be very interesting the next few weeks and months for certain. We'll continue to report to you quite regularly on our view of the world, the setups and so forth. And thank you, as always, for watching and listening, and I'll talk to you again soon. Bye-bye.